All right, hello and welcome everybody. Welcome to our community here and today's workshop that's going to be about the Secure Act 2.0 and all the updates that you're going to need to know. My name is Jason Hamilton. I'm the founder of the groups here in the page and also the founder of Keep It Simple Financial Planning. And if this is your first time here, I want to welcome you and say we're really happy to have you here. This is something that we like to do on a regular basis. We should do this weekly. And I'm looking to add a lot more content and a lot more things to value to you that we're going to put out here in the community for you so you can learn and continue to get better at your knowledge and your ability to retire with confidence. And what I want to do today is help you get one step closer, a little bit smarter, and a little bit more confidence around your retirement and your retirement goals. So that's what our whole purpose is here today, is to help you become a little bit smarter. If you are interested in getting help with your financial retirement planning, specifically, if you're looking to retire somewhere in the next 5 years or so, check out our website. I've added some new services on there, and there's more descriptions on there. There's price ranges and things like that. And also for those of you that are not planning to retire within the next 5 years or so, we have some other things there for you to just do a kind of a temperature check, see where you're at with retirement. We have some other things there that are available for you. So again, please check out our website at keepitsimplefinancial.com. A lot of good stuff there and some new updates there for you. And then one more thing there is, for those of you that may not be ready to speak with an advisor, but want to have better control or better track on your finances, I have some very cool things coming for you that are going to be much more reasonable, very low cost, but very valuable so that you can keep track of your finances on an ongoing basis. So all that stuff is coming very, very soon. So keep a lookout for that. Okay. So one thing, first of all, this will be possibly good for some. For some of you, it may not bother you at all. It may not matter. It may not do anything. But the RMD, which is known as the required minimum distribution age, okay, RMD age, required minimum distribution age, has been pushed back again. So if you remember, during Secure Act 1.0, it was pushed from 70 and a half to 72, okay? So now it's going to be pushed back a little bit further. So if you were born before 1951, this doesn't really apply to you. But if you're born in 1951 to 1959, the RMD age is now pushed back to 73. So we have one more year. So technically, nobody's going to have a required distribution that starts this year, right? So that could be good. If you are born in 1960 or later, it's going to be pushed back to 75 years old. So that'll start in 2035. So here's a couple of planning points here. So if you are somebody who doesn't need the money, okay, because in reality, most people need that required distribution to live off of. But if you're somebody who does not need the money, now this gives us an extra year to look at some tax planning, okay? So when it comes to tax planning, what are some of the main things you need to be thinking about? The first two things are going to be distributions and conversions, okay? So when you get to retirement and you no longer have a paycheck coming in anymore, we have to fund your retirement somehow, right? So that's going to be through distributions, right? That's going to be from your different retirement accounts. So most people have some sort of tax-deferred retirement account. That would be considered like a traditional IRA, 401k, 403b, TSP. Those are your main accounts that you have saved money in. You've deferred taxes on them all throughout your working career. The money is grown tax-deferred, which is a good thing because you're going to actually have more money there generally than if it wasn't. But now you have to start taking the money out of those accounts, okay? So that's going to be distributions. You might have three different types of accounts. You could have a tax-deferred account like I just mentioned, or maybe you have some tax-free accounts like Roth IRAs or Roth 401ks. That could be another type of account. So that would be a tax-free distribution. So those accounts are very valuable when it comes to your retirement planning because if you need some money, it doesn't have a tax impact. Right, so it's not going to impact, potentially taxing Social Security or paying higher taxes on a pension, for example. So that is a second type of account. And then the third type of account would be just a traditional brokerage account, which would be a we call it a taxable account, essentially. So that would be money that's not in any sort of qualified retirement account like a 403b or a traditional IRA or Roth IRA. So those are the three account types that you possibly will be drawing from in retirement. But when it comes to your required distributions, the only types of accounts that have required distributions are going to be those pre-tax type of accounts. Okay, so that's going to be your traditional IRAs and 401ks. If money's in a Roth IRA, then there is no RMD. And I'm going to give you a little sneak preview here. Actually, there's been an update with Secure 2.0. Prior, you used to have a required distribution from Roth 401ks that had to start at 72. So that forced you to roll your account over to a Roth IRA to avoid that RMD. So with this new update here with the Secure Act, now we have until 73 to have to be thinking about that currently until 2035. So what does that allow us to do? If you're somebody who does not need this RMD to live on, then it gives you an extra year to look at tax planning. And if you've been around here for a while, we've done a lot of workshops on this, but there is something called a Roth conversion, right? Where what you would do is you would convert money from a pre-tax account, like a traditional 401k or traditional IRA, and move that to a Roth IRA. And what that allows you to do is get money into a Roth IRA account that then grows forever tax-free and has no required distribution requirement on it. So it could be a really, really beneficial tax planning move for you to consider. You will have to pay tax on that conversion in that particular year. But if you're already retired, you have to remember, to get money into a Roth account, to do a contribution directly, you have to have earned income. Okay, so if you don't have any earned income, normally you can't just put money in a Roth IRA if you don't have any sort of earned income. But anybody can do a conversion. Okay? Anybody who has money in a pre-tax account like a traditional IRA, you can convert money directly from the traditional IRA to the Roth IRA, and anybody can do that even if you don't have any income. So this can be an extra year to plan and give you a little bit more space to get more money to a Roth IRA for those of you that have saved a little bit more than you may need to live off of. Or maybe you have a lot of fixed income sources like pensions, annuities, or Social Security that covers all of your main income needs. So that is something that this could be a benefit for. So it's been pushed back a little bit more. A couple things to be considerate of on this are when that RMD comes, from what it looks like, they haven't actually slowed down the schedule. So it could be a bigger first required distribution than you might be expecting at 72. And when this goes to 75, similar, right? So from 72 to 75, you have to remember each year that you're required to take a distribution, each year that distribution amount goes up a little bit because the government's goal is to get you to distribute everything from your accounts or most everything from your accounts before you pass, right? So as you get into your 80s and 90s, those RMDs go up. So ideally, if you can get control of this early by doing some tax planning, if you're somebody in your early 60s, for example, you might have 10 years or more to look at this planning and really take advantage of the lower tax bracket. So again, this is beneficial if you're somebody who's going to be looking at not needing all this money and doing some tax planning early on. So a little bit more on this here. So RMD age is pushed back. So that means no retirement account owners will start RMDs in 2023 or 2033 because of their age. So this has no impact to the age which QCDs can be made. So QCD stands for Qualified Charitable Distributions. You can actually make distributions directly from your IRA accounts to your charity, to a qualified charity, a 501c3, without paying any tax. So if you're somebody who wants to give to your church or a charity, at 70 and a half, you can start giving directly from your IRA, and then they get that pre-tax amount, which is a beautiful thing. And that will allow you to contribute there. There's no changes to that. So 70 and a half, that can start without any sort of problems. So like I said, this does not mean your RMD will be less and could lead to a large tax jump if not planned for. So this is something that you really want to be planning for when it comes to your tax planning later in retirement. I've talked to quite a few people that come to me too late. Okay, they hit 72. And they had this huge tax distribution or huge taxable distribution from their IRA or 401k that they just didn't plan for and they weren't aware of. And they honestly didn't need the money beforehand, so they let it just compound. And now, especially for you single filers, okay, for you single filers, if you have more income than you need, you can hit what's called the IRMA income limits. So for IRMA, we're going to be looking at for single filers here. And remember, if you have your key numbers that you can get from my website, you can check this out anytime. So our IRMA limit now is $97,000 or less. Okay, $97,000 or less. So once you go over $97,000 of income as a single filer, you go into the anti-IRMA penalty, which means you can actually have to have additional costs for your Medicare. So if you have a big required distribution, this could potentially be a big problem for you when it comes to retirement later down the road. So keep that in mind. Unfortunately, folks, I wish the government made things more simple. These things are going to actually require more conversations with an advisor. And ideally, you're going to get somebody who's not just doing investments for you. You want to get someone who's going to do comprehensive planning. So tax planning is that question you want to ask. If you're looking for an advisor, yes, you want to ask if they're a fiduciary. Okay, so certified financial planners now are all required to operate under a fiduciary standard. I'm not saying it's perfect, by the way, but it's one of the best things you can do to protect yourself. And then number two is say, hey, do you offer tax planning services for me in retirement? Because a lot of times you go to those big name brokers, not going to mention any names here, but they're going to say, hey, anytime you have a tax planning issue, they're going to say, hey, no, you need to talk to your CPA about that. The problem with that is once you're getting to retirement, there's a lot of different variables. I look at them like pieces of a puzzle that need to be fit together and optimized in a really efficient way, because when you get that right, you'd be really surprised on how much money you can add to your bottom line of money that you either keep from taxes, or you can actually pass on as a wealth transfer if you're going to be leaving money behind for your kids or grandkids, whatever it may be. So these are things that you need to start thinking about when it comes to who's going to help you with your retirement planning. So you want to ask them, hey, do you offer comprehensive financial advice? Not only on my investments, but I need advice on integrating my tax planning and my other strategies when it comes to my retirement planning. So, okay, this is more important to ask this now than ever because more things have come up with these new changes. So Roth account related changes, okay? So lots of stuff in the Roth account related changes, mostly good, by the way, mostly good. Except for one thing, which depends how you look at it, could be a good or bad thing. So let's dive into this a little bit. So as I mentioned prior, beautiful thing now for Roth 401k accounts. There are no RMDs for Roth 401k accounts or similar. So if you have a 403b, Roth TSP, there's no RMD requirement. So prior, this was a no-brainer for us as financial advisors. We would recommend always rolling over the Roth 401k over to a Roth IRA because it avoided the RMD requirement. So now we got to look a little bit deeper as planners. Okay, so you got to look at it and saying, hey, the Roth 401k, how are your options there? Are they expensive options? Is there a plan administrative fee that you're gonna have to pay? Or does it have enough of a diversification of options that you feel comfortable leaving your money in the Roth 401k? If those are all no's, or any of them are no's, then you really might want to think moving to a Roth IRA. And in all honesty, I like the Roth IRA because you can transfer and do your conversions very simply from there, where it's a little bit more work to do it from a 401k, because a lot of times you have to submit a form and it just takes a while to get that done. So again, that's a personal preference and you want to speak with your advisor about that. Number two is this here is effective starting 2024, okay? So there's no RMD requirement anyways for 2023 if you're starting this year, but it is effective 2024, so keep that in mind. As I mentioned here, rollover decisions are now more closely resemble traditional 401k to traditional IRA decisions. So those are all things that need to be considered, mostly in sense of like control, simplification, fees, and investment options. Those are some of the things you want to think about in that specific conversation. A couple additions. We're now going to have Roth Simple and Roth SEP accounts. Okay, so that's really cool for those of you that are self-employed or maybe want to have a some sort of self-employment in early retirement, or if you're just self-employed in general. So that's effective now in 2023, but nowhere I've seen are those custodial accounts available yet. Okay, so they're not out there yet. I'm looking for one for myself. I like to SEP, IRA for myself personally to save for my retirement, but it's not available yet. And to keep in mind that if you do contribute to those accounts, those amounts are included in your gross income, okay? Where if you contribute to a pre-tax account, like a traditional IRA, then that gets deducted off of your gross income. So some things to keep in mind here. So employer contributions can now be designated to Roth. So this is a big deal, okay? So if for those of you that have been getting a match from your employer, like if you put in 5%, for example, and your employer gives you another 5%. Prior to now, those contributions have always been pre-tax, okay? You have not been able to choose Roth for that. So this is a new change. This is a big deal, okay? Because if your employer is giving you match, it's free money, well, this becomes a big decision. How do you want to get that money? How do you want to get that match? Because yes, the amounts, as it says here, the amounts are included in gross income, okay? So the amounts are included here in gross income. But in my opinion, depending if you're on the border of a tax bracket or not. So this is where, again, you have to get a little bit deeper with your tax planning discussions. If you are not on the border of the next tax bracket, let's say you're in a 12% bracket, you can now have this money go to Roth. Yes, it's included in your income, okay? But in my opinion, who cares? It's free money anyways, right? You're going to pay tax on it today, but then it's never taxed again. But let's say you're somebody who's right on the border of a tax bracket. Let's say you're making, $89,000 and you're a single filer. And now by getting an additional 5%, you're going to get around, almost $3,000 additional in match. Well, what's going to happen if that money goes to your income? If that bumps you a tax bracket from 12 to 22, well, you may want to really think about that, because very few people are really in the 22% bracket or higher in retirement. I'd say probably 1 or 2 out of 10, that I speak with. So if you're going to be in a 12% or lower tax bracket in retirement, that match going to the 22 today may not be a smart move. Okay. So this is what I'm saying about these tax planning conversations need to go a little deeper. And this is why, like, if you were working with someone, and I'm not bashing on this company, but Vanguard, great company. Okay. Massive company. Investments are very low cost overall. I think they're very focused on the client, and I think that's great. But their advisors, they have a cheap service where you pay like 0.3% of assets or something like that for your assets under management fee. From my understanding, from everything I've seen and my research, they don't offer any sort of tax planning. So you might be getting some help there with your investments for a very low cost. But if they're not helping with you with these decisions, you have to really ask yourself, what is this costing you over time, right? So these are things where you might want to seek out advice from a fiduciary advisor that has a tax focus to help you make those decisions, okay? So this applies to matching and non-elective contributions. So it does not apply to profit sharing. But one thing that's unclear is how the IRS or DOL will view the plan when the plan has a vesting schedule, since the contributions must be non-forfeitable. So what this means is like, let's say, for example, you join a company and they say, okay, we're going to give you a match, but you don't get to keep that match for 2 years. I don't know. I'm just making up a plan. Normally it's 1 year or so. Well, if you've already paid tax on this and these are non-forfeitable, then the company is going to probably have to change their plan, right? So this is something that you want to be aware of. Again, these are things that need to be worked out, but they're coming. Okay, so think about these when you're looking into this. Next thing here is high wage earners. So if you make over $145,000, this is going to be a big change. Okay. If you do catch-up contributions, so that means you're age 50 or older. Okay. Right now the catch-up contribution is $7,500. So you can normally contribute $22,500 to your 401k from your contributions. Okay. This is your contribution, not including employee match. Your catch-up contribution, if you're age 50 or older, is another $7,500. So prior, you could put that directly to your pre-tax account and not pay tax on that full $7,500. Well, now, if you make over $145,000, that catch-up contribution is going to have to go to Roth. Okay. So again, viewpoints. This may be good, may be bad. It really depends on your situation. But the challenge is going to be for your plan providers is there's no catch-up allowed for anyone in the plan if an age-eligible high-wage earner cannot make a catch-up because the plan does not have a Roth option. So this is very common that plans don't have Roth options. So again, these are going to be big changes coming down the pipeline that are going to come into your plan. So you want to make sure you speak with either your HR, your benefits professional, or your financial advisor to help you make a good choice here. So big deal. Next thing is 529 to Roth IRA transfers. Okay, so this is new. So now, let's say you have a college plan that was funded, okay? And let's say that funding was never used because your child or grandchild didn't go to college or didn't spend all the money. Well, if there's money that's not used, generally what you have to do is pay, you can get the money out, but you're going to have to pay tax on the earnings and a 10% penalty, right? So that is something that you have to think about with what to do with 529 money. Well, now there's a new option to do a 529 to Roth IRA direct transfer. There are some rules with this. You have to be really careful, and the account has to be open for about 15 years. So this is not something that you could just do immediately. But a couple things to be conscious of are the money must be moved directly from the 529 plan to the Roth IRA. There's no 60-day rollover. So for example, if you have a 401k and you want to roll that over to an IRA, you can take a check, get the check, and as long as you deposit within 60 days, there's no problems, okay? This is not possible with this particular move. So the money has to go directly from the 529 plan to the Roth IRA. And the second thing there is the Roth IRA receiving the funds must be in the name of the beneficiary of the 529 plan. Okay, so this person who is the beneficiary has to have some income that they're earning as well. The other things there is it's the 529 contributions and earnings go into the Roth IRA in like kind. So if they're contributions versus earnings, it's going to be kept like that when it goes to the Roth IRA. So you keep that in mind. A couple other things to be aware of here is the beneficiary must have compensation, like I said. The 529 plan must have been maintained for 15 years or longer. So this is interesting, okay? So many of you have heard of the 5-year rule with the Roth IRAs, where if you don't have an account open for 5 years, you can have some challenges when it comes to withdrawing earnings at some point if you need to. Well, this is similar to that, where I might advise a client that, hey, we don't know if we need this money, but just open a Roth IRA, put $100 in, and start the clock. This is a similar conversation that I might be having with certain clients, is that since we have this 15-year window, maybe your kid does want to go to college, maybe they don't, but let's start the clock on the 529 so that maybe in 15 years, you can do this move, if need to. Or your beneficiary, like let's say they get a job. Let's say you have a daughter, she's 3 years old right now. And then so we start a 529 plan to plan for college. But by the time she gets to 18, well, now she has decided she wants to work. Well, now you can take this account, your 529 account, if she has earned income of at least the amount that goes that's available for the Roth IRA contribution. And now you can start moving that money over and give her that money into a Roth IRA and start her retirement plan. This could be, again, a really powerful wealth building move. And these are things, man, that when you're just working with, again, I love these big custodians. I think they're great, Schwab and Fidelity and all that. But if you're not getting this individual advice and you're somebody who has a little bit more of a technical situation, you might be missing out on these long-term planning moves that can be very, very powerful for you, okay? A couple other things there. This is subject to the IRA contribution limit, less any regular traditional IRA or Roth IRA contributions annually. So if they've already put in $2,000 for the year and the contribution limit is $6,500, you can only do $4,500 in that particular year. So keep that in mind. And the maximum lifetime transfer to beneficiary is $35,000. So the most we can do here is $35,000 to this particular account. So all things to be considered when making these moves, but hopefully you found, maybe you'll find that interesting at some point. Roth, simple, and SEP accounts. This is going to be effective now in 2023. Like I said, have not seen any custodial accounts available yet. And then the next thing here is new catch-up contribution limits for all these different plans here. So this is another interesting one. All right, so new catch-up contributions. Let's talk about IRAs. So this will be effective in 2024. Now, the amount indexed for inflation for catch-up contributions. Okay, so remember before it was $6,500. You can put another $500 in, or another $1,000 now to your IRA if you are 50 years or older. A few years ago, IRA contributions were $6,000. Now they're $6,500. So that amount has been the normal contribution amount has been indexed for inflation over time. So it used to be $5,500, then it was $6,000, now $6,500. The catch-up contribution of $1,000 has been the same for a while. So the catch-up contribution was not indexed for inflation, but now it's going to be indexed for inflation. And that's going to start with $100 increments. Okay, so that will be in 2024. That will potentially start. So that means your catch-up contribution could go from $1,000 to $1,100, for example. So that's a little bit interesting. 401k and similar plan contributions. So this will cover 401k, 403bs, TSPs. So effective 2025. And this is applicable only to participants 60, 61, 62, and 63 during the year. Okay, this is really tricky stuff. But the catch-up contributions are going to be limited to either $10,000 or an amount equal to 150% of the dollar amount, which would be in effect under such clause for 2024 for eligible participants not described in the parenthetical such clause. All that means is, currently, for example, your normal contribution for your 401k or similar plan will be $22,500. Once you turn 50, you can do a catch-up contribution of an additional $7,500. But starting in 2025, it's going to either be $10,000 or potentially 150% of whatever that number is. So if it was done today, it'd be $11,250. So this is going to allow you to put away more money for retirement. Again, ideally, you can save this much for retirement. Not everybody can, but these are things to help you stash away more money for later down the road to help you have a more comfortable retirement. So that's 401ks. And for simple IRAs, we're going to have a $5,000 limit, which is currently $3,500, or 150%, of whatever the catch up is at that point. So if it was done today, it'd be $5,250. So as we see here. So, all right. New post-death option for surviving spouses. This is another one that can get a little bit tricky. So I'm going to read off a couple of these things here. All right. So new post-death option for surviving spouse beneficiaries. So this comes into effect 2024. The election to be treated as the decedent for RMD purposes. So this can allow some flexibility with how you distribute IRA accounts, for example. The thing that we need to know now is that election should be treated as irrevocable. So once you select an election, you cannot change it until we know otherwise. And this does not appear to impact the penalty exceptions for beneficiaries. All right. But some of the effects are RMDs delayed until the deceased spouse would have reached RMD age. So let's say you inherit an IRA. If you choose to be the beneficiary as of their age, well, then you could potentially delay until they would have had to take the required distribution on that. So this is interesting, right? So if you're a surviving spouse, this can be something really interesting. Sole spouse beneficiaries will calculate RMDs using the Uniform Life Table. And if the surviving spouse dies before RMDs begin, the surviving spouse's beneficiaries will be treated as though they were the original beneficiaries. So again, this is something that should be talked to about with your advisor and also your estate planning person. But a lot of updates there. I have this flow chart that's just like really crazy. And so this is something I just didn't want to get into too much here because it's a lot. You really should speak to somebody about this, but there are some new options there. So keep that in mind as you're thinking about your beneficiaries. Okay, this is another one. A lot of information here. Okay, enhance access to retirement funds during times of need. Okay, so a lot to cover here. So age 50 exception for public safety workers. So this has been expanded to include private sector firefighters, state and local correctional officers, plan participants who separate from service after 25 years of service. So this is interesting. If you're a plan participant who separates from service after 25 years of service, this has now expanded your ability to access these funds. So this is effective immediately, apparently, upon enactment. Qualified disaster recovery distributions. So if you remember, when we had the big hurricanes and things like that, we could take out distributions from your account and then spread out the tax bill over the next few years. So now this is effective and it's retroactive for disasters occurring on January 26, 2021. I'm in California right now. We're in the middle of a disaster in Northern California where I'm at. Everything's good, but there are places that are facing crazy flooding. And so this will probably come into play here. This provision is to be made permanent. So this was a temporary provision to allow these distributions prior. It's now made permanent. This does apply to IRAs and employer plans. And this distribution must generally occur within 180 days of disaster. Okay, so you have 6 months after disaster to do this. The maximum lifetime distribution is limited to $22,000. Not a lot of money. Okay, unfortunately, it's not a lot of money. And another thing that was mentioned when I was learning about this, I thought was really interesting. So if this distribution is split over 3 years, why couldn't they make it $21,000 or $24,000? They made it $22,000. So now you're going to have an annoying, $7,333.34 in 1 year. It's just really annoying. But anyways, I thought that was funny. So the maximum distribution lifetime is limited to $22,000. Your primary residence must be located within a federal disaster area, and the distribution income spread over 3 years, beginning with the distribution year by default, but the taxpayer may elect to include all income in the year of distribution, but it is repayable for up to 3 years. All right. There's a new terminal illness distribution option. So this is effective immediately. So this applies to IRAs and employer plans. And the definition of terminal illness is made extremely broad. So it was normally a 24-month rule, like if you're expected to pass away in 24 months. This is now expanded to 84 months, which is 7 years. So this is a little bit tricky, right? So some of this stuff, we're not going to see how it plays out until someone tries to do it. But if you get diagnosed with some sort of terminal illness that you're expected to pass within 7 years or sooner, you're now going to have additional options to get some of this money out without penalty, which is a good thing, I guess. And then the distributions are repayable for up to 3 years. Okay. Next one is new exception for victims of domestic abuse. Apparently, there's a big problem with domestic abuse in our country. I'm really sorry to hear that, but this is something that they had to put into the Secure Act because it's such a big problem. But this will be effective in 2024. It applies to IRAs and employer plans. There's a maximum distribution limit to the lesser of $10,000 or 50% of the vested balance. Okay, and this must be taken within 1 year following the incident of abuse. The distributions are repayable for up to 3 years. So this is for somebody who might be suffering from abuse that needs to just get out of there, and maybe they're not old enough to take money out of their retirement account. This will allow that distribution without the extra penalties that come on there. You just pay the tax, and the tax could be distributed over 3 years. The abuse is actually very broadly defined: physical, psychological, sexual, emotional, economic. So economic abuse, that's an interesting one. Again, these things probably have very specific definitions, but you want to look into that. And it includes efforts to control, isolate, humiliate, or intimidate the victim, or undermine the victim's ability to reason independently. So this is a very, very wide option here, and includes means of abuse of the victim's child or other family member. So, there's obviously some problems that we have to deal with, and I'm really sorry to hear if people are dealing with this, but at least now you have a little bit more of an option to access your funds if needed. All right, we have a new emergency withdrawal exception. This will be effective in 2024. So finally, what is it? Effectively a hardship exception to the 10% penalty, but it's limited to a maximum of $1,000 per calendar year. So this is basically, again, it's a really small number, but it's just what it is. So only if one of the more of the following apply. You have taken your prior emergency withdrawal distribution has been fully repaid, and contributions or deferrals to the IRA or plan since previous emergency withdrawal exceeded that of the amount. So what that means is you can get it's like $1,000 emergency fund, right? So you Dave Ramsey fans, your baby step one emergency fund of $1,000. That's what this could be used for, and it can be taken from your 401k or IRA. So there's going to be some new updates to 401k plans, or workplace plans, I should say, that are going to have options for like the first $1,000 just being a fixed emergency type option, and then from there investing after that. So a lot of this will remain to be seen, but we'll see over time kind of how that goes. There is a new qualified long-term care distribution exception. So this is effective 3 years after enactment. So that'll be December 29, 2025. And it's limited to the maximum dollar of the lesser of $2,500 or 10% of the vested balance. Yeah, so this will be on amounts paid or assessed during the year for qualified long-term care insurance. So this is money that you can use from your 401k, for example, to pay for long-term care insurance. This could be good. So the IRS may allow distributions to be used for other families' coverage, but that is not clear yet. And distributions only eligible for spousal coverage if a joint return is filed. So if you are married, but you don't file a joint return, then you cannot use this money to pay for someone else's long-term care insurance. So something to think about there. There are going to be expanded loan options for our participants. So generally, the loan options from 401k were $50,000. Now that's going to go to $100,000. And this is for if you're in a disaster area. Let me just clarify that. This is if you're in a disaster area. So this is your primary residence must be located within a federal disaster area, and participants are eligible to use the entire vested amount towards a loan. Like I said, it's generally limited to the greater of $10,000 or half the vested balance, and certain loan payments may be delayed for up to a year. So if you're dealing with some things, this is a good thing to potentially access. And there's going to be a creation of a linked emergency savings account, like I was just mentioning there. So this is effective 2024. Emergency savings accounts must be attached to an employer plan account. So this is going to be required, I guess, for employer plan accounts. So highly compensated individuals will be ineligible to participate, and employees may be auto-enrolled at 3% of compensation, and that account balance may not exceed $2,500 of attributable contributions. Account balance may not exceed $2,500 attributable to contributions. So the plans may establish lower limits, but it's unclear how they must be apportioned for contributions versus earnings. And the plan, like I said, can auto-elect participants to stop or to plan Roth accounts. I think that's it for these enhancements. There's some other things in there, but some of them just get into the weeds. So we're going to move on to the next one, which is relief for retirement plan mistakes. Okay. So for those of you that have ever missed a required minimum distribution, you know the penalty's terrible. It's the worst penalty there is. 50% of the amount you're supposed to distribute. Very few people actually pay that. And if you do make a mistake, the IRS will generally kind of give you, let you go on the first one. But now that penalty, which was 50%, has now been reduced to 25%. The penalty will be further reduced to 10% if fixed during the correction window. So the correction window begins on the date the tax is imposed and ends at the earliest of when the notice of deficiency is mailed to the taxpayer, when the tax is assessed by the IRS, or the last day of the second tax year the tax is imposed. So that's good, because that's kind of, that's pretty tough. If you forget to make your RMD, you forget to take your RMD, and then they charge you 50% on that amount. Like I said, very few people pay that, but that is getting reduced. And then the statute of limitations for certain IRA penalties is being changed. This is effective immediately. The statute of limitations for a missed RMD penalty to begin filing on Form 1040. So it will begin upon filing the Form 1040, and there's an exception in situations related to Roth IRA's acquisition of property for less than fair value, but the statute of limitations begins on the due date for Form 1040 if such return is not required to be filed. Some of this stuff is unclear, so keep that in mind, but I just want to make you aware of it, and I think that's mostly it for retirement plan mistakes. Let's go to our next section here. All right, other additional changes. We're coming around the corner here, but there's a lot. Like I said, there's over 100 changes. It is a lot. Additional changes. Employer matching of student loan payments, effective 2024. Employers can match payments plan participants make to their student loan. So this could be interesting. An employer can match what someone is paying to a student loan. So for those of you that are a little bit closer to retirement that don't have student loans, maybe talk to your grandkids about this. So right now, it's the employers are going to be able to rely on the employee certification of student loan payment. So basically, if you're an employee and you tell your employer that you made the payment, that's all they really need. They may have you sign a form or whatnot, but right now there's no requirement to actually provide proof of this. So that's something to be aware of. There are changes to the Savers Match. So Savers Match, tax credit contributed to a traditional retirement account for up to 50% of the first $2,000 of taxpayer contributions to a retirement plan. So that has been increased. So the government, if you are on the lower income side and you contribute to your retirement plan, you're going to get a match up to the 50% of the first $2,000. So that's $1,000 that can go into your retirement plan. So if you're on the lower income side, you should definitely be thinking about this. Individuals are ineligible if you're under 18, claimed on as a dependent on another person's return, are a full-time student, or have income that exceeds the relatively modest thresholds. Okay, things that did not make it. Okay, so these are things that were definitely talked about around this group that I think you should be aware of. Limiting the use of backdoor Roth or mega backdoor Roth contributions. That was something that people were really worried about. Will backdoor Roth IRA contributions go away? What is a backdoor Roth IRA? What it is if you put money, like let's say you cannot contribute directly to a Roth IRA. You make too much income. Well, what you could do is put money in a traditional IRA that's a non-deductible IRA, and then you can immediately convert that, or once the money settles, and you have proof that it's settled, you can immediately convert that to a Roth IRA, and well, now you put money in a Roth IRA even though technically you didn't qualify from an income standpoint. It's an annoying thing to keep track of that you have to keep track of forever with your tax filings, but it's a way to get money to a Roth IRA if your income is high. That didn't make it in here. So people were really worried about that because there was talk about that, but it's not in. Nothing there to worry about. There was nothing in there about placing new limits on who can make Roth conversions. So basically, if you want to make a Roth conversion, you want to convert money from your pre-tax account to a Roth account, there was no limits on who can do that now. That was talked about, like certain income levels might not be able to. There were some limits potentially discussed, but didn't get in there. Creating non-age-based RMDs. Didn't make it in there. Changing the age at which QCDs, the qualified charitable distributions, can be made. It's still 70 and a half. That didn't change. Eliminating new types of investments from being eligible to be purchased with IRA money, such as privately held investments. Didn't make it in there. One thing that's disappointing, that they did not correct or clarify the manner in which the 10-year rule enacted by the original Secure Act, which is what I was speaking about when I talked about the IRAs, so Roth IRAs and traditional IRAs. You have to have everything out within 10 years. They did not clarify that or correct that for non-eligible designated beneficiaries. So that's what I have for you today. I want to thank you for joining today. I'm going to do some questions as well if there are some questions here. But if you are somebody that sees some of this, that feels that you might be a candidate for getting some help on your particular situation, then I would be happy to speak with you. You can go to keepitsimplefinancial.com/talk to find the link there, and hopefully some of these things will be able to be worked out. Go ahead and put your questions in the chat. But if you have any questions or comments, I'd love to hear from you today and see if there's a way I can help you out. Okay, so how do you figure the tax on a Roth conversion? And when do you pay the tax on the Roth conversion to avoid government penalties? Really, really good question. Okay, so how do you figure the tax on a Roth conversion? So essentially, when you're doing a Roth conversion, what you're doing is you are increasing your income for the year. So whatever tax bracket you are currently in will be the amount of tax you have to pay on that Roth conversion, for example. So let's say you're in the, let's say your income is $60,000, okay? And let's say you're filing joint and married, and you have up to about $90,000 to hit the 22% bracket. So actually, let's pull this up. You know what I like to do? I like to pull things up here. Let's do an actual, let's look at this here. This will be helpful. So for a Roth conversion, okay, so let's say you're here. Okay, so let's say you are in this range right here, okay? Your income, your taxable income is $60,000. So that means you'd be above $22,000, but below $89,450 as a married joint filer, okay? So if you did a Roth conversion and you move money from your traditional IRA to your Roth IRA and you did $10,000, okay? So now instead of $60,000, you're increasing your income to $70,000. But you're in this 12% bracket, so that means you're going to owe 12% of that $1,000, excuse me, of the $10,000 you converted over. So that's going to be a $1,200 tax bill for you. Okay. And to avoid the government penalties, you want to pay that, throughout the, by the next quarterly due date, essentially. So if you search up when estimated taxes are due, they're due, I think it's like April 15th, June 15th, September 15th, and January 15th, like those 4 dates, somewhere close to that. So as long as you pay the estimated tax before that, then you'll avoid the government penalties. I took my TSP and transferred it to an IRA account, and I was told I can't transfer it into a Roth IRA. Is that true? But I have it backed by gold and silver is also a good thing. So I don't know about that. So it's not true that you can't transfer money from your traditional IRA to your Roth IRA. You should be able to transfer funds that are in there. The fact that it's backed by silver and gold, I don't know about how it's backed by that, or if there's money, you're saying there's silver and gold in your account. So I can't really answer that question, but the first one should be pretty simple. Say, hey, it's Deb. Hey, Deb. Are the Roth 403B accounts still used in the calculation of RMD? No. Roth 403Bs, once this becomes enacted, you will not have an RMD on those accounts. So you won't have to worry about that if it's a Roth account. All right, so I know on a non-spouse inherited IRA, it has to be withdrawn in the 10-year period. Correct. Are RMDs going to be required? Yes. Okay. So this is something that was very unclear. They've forgiven the penalties for 2021 and I think even 2022, but you really should be making an RMD. This is what I mentioned at the end, that we're looking for clarification on this 10-year rule, and there hasn't been clarification yet. So unfortunately, we don't know how much each year, but you should talk with your tax professional and figure out a number that you agree on, and definitely you should be thinking about that. Okay. So if I opened a Roth IRA 2 years ago and I'm 59 and a half years old, I can do a conversion now without the 5-year clock resetting. Well, you can do a conversion now. Yes. Technically, there is a 5-year clock, but the thing is that would only have to do with your earnings. Okay. And so you can take out your contributions to a Roth IRA anytime. And once you're 59 and a half, and you have to remember that contributions come out first. So you wouldn't have to really worry about that too much. But honestly, Tammy, why would you want to do a conversion and then take the money out now? That doesn't make any sense. If you're going to do a conversion, that's for money that you want to then compound and grow forever tax-free. If not, you would just take the money out and use it, right? That to me wouldn't really make a whole lot of sense. So if you're going to do a conversion plan, this should be a long-term plan for you. Okay, this shouldn't be something that you just do and then take the money out the next year. So hopefully that helps, Tammy. So what is the dollar limit on a Roth conversion amount per year? Beautiful news. There's no limit. Okay. You can convert as much as you want. Should you convert everything? No, you shouldn't. You should really figure out what the best tax bracket is for you and then convert up to that amount. And that's it. but there is technically no limit. If you wanted to do something crazy and convert your whole account, you could do that, but I would not recommend that. So Janet asks, I have been lax in starting 529 plans for grandkids that are ages 10, 9, and 4. This sounds like it may still be beneficial if it could get rolled over into an IRA. Potentially, Janet. I wouldn't really focus on your 529 contribution plan being a way to get money to a Roth IRA, because in all honesty, you could just give them money if they're working to put in a Roth IRA. But it's a way to utilize these funds if they weren't utilized for college, for example. And 529s, depending on your state, may have an additional advantage where you could get a state deduction on your tax return. So that's what I would be thinking about first, Janet, because if you've never started the plan, you have to wait 15 years to do what I was speaking about today, about converting it over to a Roth. But if you get a tax deduction in your state, this could be a tax deduction you claim for this year. So I would focus on that first. Hopefully that's helpful. All right, and this is the last question, then we're wrapping up today. So right now, gross $150,000, plan on retiring this year at 62, we're 3 kids, $700K in traditional TSP. Should I ladder over to Roth IRA in my 60s? And should I pay for taxes with cash, or should I pay using the money in TSP? This is a really good question, okay? So I would want to know if your gross is going to change. And most likely it's going to go down. So you're retiring this year at 62. So you're like the perfect candidate for what I spoke about and looking at Roth conversions between now and 73. You're like the perfect candidate for this, especially if you don't need this money, okay? If you're going to need your RMD, then maybe you might just want to leave it, not pay the tax today. It's kind of up to you. But you're the perfect candidate for somebody who should look into a tax plan to help you figure out how much to convert each year, what your best tax bracket is going to be, because if you're going to be in a lower tax bracket today than the future, especially if you just turned 62, you may have not taken Social Security yet. And if you're retiring next year, you may have no income at all. So this could be the best time for you to be thinking about doing you call it a laddered conversion, you can call it that. But I would call it just a tax bracket focused conversion. So whatever tax bracket that makes the most sense. And for most people, it's 10, 12, or 22. Some people make sense to go to 24, but very few. But if you have a TSP, you may be a government worker who has a pension. So this would have to be coordinated with your pension. Okay, so all things to think about, but hopefully that answers that first part of the question. And then the second part of the question is, should you pay with taxes with cash? Yes. I always recommend paying for the taxes with cash, because the thing is, if you're converting all that money over from a pre-tax account to a Roth account, you want to get as much money in that Roth account as you can. And if you pay the taxes out of cash, then the full amount's going to go in. If you have to pay that money out of your IRA or out of your conversion, then less money is going into the Roth account. So it's less beneficial. If you don't have cash, then no big deal. Just pay it out of the IRA. But if you have cash, then you should definitely be thinking about paying it out of cash first as a primary without messing up the rest of your plan. So, all right, folks. So hopefully that was helpful. Hopefully you enjoyed this. We're going to be doing more of these, okay? If you want to get some help, you want to discuss your retirement plan, go to keepitsimplefinancial.com, and we're happy to help you out. Thank you so much for hanging in with us on this. We're going to have a lot more of these coming. I hope you enjoyed these. And like I said, we will be taking this down, repurposing some of it, and hopefully breaking up into smaller pieces of content that's more digestible. This hour-long stuff, I know it's long, but I don't have so much time. So I'd rather sit with you for an hour, get this out, and then my marketing team will be putting pieces of this content over the next few weeks in here so that you can continue to grow, increase your knowledge, and be reminded of some of the things we talked about today. So thank you again. And once again, if you need help, reach out. But other than that, we'll see you around. We'll see you probably next week or in the next 2 weeks for another presentation. All right. Have a great week.